Hello, welcome back to my channel. I'm Melissa. In today's video, I am going to talk about registered retirement savings plans, what it is and how it works. A registered retirement savings plan, RRSP, is a type of savings account that Canadians can use to save for retirement that is registered with the federal government. RRSP is not an investment product that you purchase. On the other hand, is like an umbrella that shelters investments, such as mutual funds, stocks, guaranteed investment certificates, exchange-traded funds, and bonds. Once you make a contribution, you can buy or sell investments, or change the investments you own. As long as your cash, investments, and any returns on your investments stay inside your RRSP account, generally there won't be tax implications. RRSP gives you certain tax advantages like tax-deductible contributions, tax-sheltered compounding, and tax deferring. Many financial institutions, such as banks, credit unions, investment businesses, and internet investing platforms, provide RRSP accounts. It's also possible to have numerous RRSP accounts with various financial institutions. You might, for example, have a group RRSP with your workplace, where contributions are deducted automatically from your salary, and an individual RRSP with your bank, where you make additional contributions. Make sure that the total of your RRSP contributions does not exceed your contribution room, which you can see on your annual notice of assessment from the Canada Revenue Agency. This deduction limit is equal to the lesser of 18% of your previous year's earned income or the maximum contribution limit, which varies each year. It's vital to remember that any unused contributions in a given year are carried over to the next year. You can also contribute to an RRSP this year and defer the tax deduction for a later year. This is an option to consider if you believe your tax rate will increase in the future but you still want to benefit from tax-sheltered compounding now. Canadians pay federal and provincial taxes on their earnings, but their taxable income is reduced when they contribute to an RRSP. You're putting money aside before it's taxed with the purpose of using it as a source of retirement income. Because you'll be paying income tax on your savings later in exchange for having your taxes reimbursed or reduced now, this is referred to as tax deferring. The amount of a tax refund or decrease you receive is determined on how much money you put into your RRSP. Furthermore, the amount of income tax you pay varies from person to person and year to year. It's important to understand how income tax rates work before deciding whether or not to contribute to an RRSP. Let's look at the federal income tax as an example. In 2021, everyone pays a federal income tax rate of 15% on the first $49,020 of taxable income. Please keep in mind that this limit may alter from year to year. If your earnings exceed this amount, the next portion of your earnings is taxed at a rate of 20.5% up to the next limit. If you earn more than that, you will be taxed at even higher rates. These are known as tax brackets. In addition to these federal rates, each province and territory has its own tax brackets that operate in a similar manner. Your tax return or reduction will be larger if you contribute to an RRSP if you are in a higher tax bracket. A $1,000 RRSP contribution leads in a federal tax refund or reduction of $330 since someone in the highest tax bracket pays 33% tax on their final dollar of income. A $1,000 contribution from someone in the lowest tax rate results in only a $150 return or reduction because they pay only 15% tax on their income. A decent rule of thumb is to contribute to an RRSP while your income is higher and withdraw money when your income is lower, which is often the situation in retirement. Let's take a look at an example from 2021 to show how this works. Let's say you're 30 years old and earn $100,000 per year in Ontario, but you don't have any RRSP contributions. You owe $23,378 in taxes. If you choose to contribute $10,000 to your RRSP, your taxable income is lowered to $90,000. Your marginal tax rate will be reduced as your taxable income decreases. Overall, this investment reduces your taxes payable to $19,621, saving you $3,757 in tax. In addition to the money you've saved in taxes, you'll reap the benefits of compound interest. If we assume a compounded yearly rate of return of 7%, over the next 25 years, your $10,000 investment will increase to $54,724. But what happens when you start to withdrawing money out of your RRSP at retirement? Anytime you take money out of your RRSP account, the full amount withdrawn will be added to your taxable income. Let's assume in retirement, You earn $20,000 a year from a work pension, but decide you need an extra $5,000 a year that you withdraw from your RRSP account. At tax time, CRA will charge you income tax based on $25,000, not $20,000. You can take money out of your RRSP before retirement, but it will cost you. Any money withdrawn will be subject to a 30% withholding tax. And because the withdrawal is deemed taxable income, you may have to pay additional taxes at the end of the year. The rule of withdrawal has two exceptions. The first exception is if you're a first-time home buyer. Under the home buyer's plan, you and your spouse or partner can withdraw up to $25,000 tax-free from your RRSP. You must, however, reimburse the withdrawal in full over a 15-year period. The Lifetime Learning Plan is the second exception. This permits you to take a total of $20,000 from your RRSP, up to a limit of $10,000 each year, to pay for your or your spouse's education. This can't be used to pay for a child's education, unfortunately. To avoid paying interest or taxes, you must repay the funds over a 10-year period. If you're selecting between an RRSP and a TFSA, choose the RRSP if you're close to or at the peak of your earning potential, as you'll save money on taxes immediately. If your current income is lower than your projected income, delaying contributions to your RRSP until your income rises could save you more money in taxes. Rather, putting money into a TFSA now will allow you to earn money tax-free when you're in a higher tax rate later. To learn more about TFSA, watch my previous video. I'll include a link in the description. That's all there is to know about RRSP basics. If you like this video and want to see more from me, please subscribe below, hit the like button and come back next week as I'll be bringing more personal finance advice.